Hello everyone. I tried going live a minute ago, but it says my connection wasn't strong enough. So anyway, we'll try it again. Today's video won't be political. It's just going to be informative. We're going to talk about inflation as the main topic, but you cannot talk about inflation and without talking about debt and without talking about the Federal Reserve. So we're going to break that down. I know your time is valuable. Thanks for watching, and I will try to be as brief as possible. First thing, let's talk about the Federal Reserve real briefly, and we will get back to it in a minute. The Federal Reserve in 1910, a group of bankers, not politicians, they met on what's called Jekyll Island. It's a property which is owned by J.P. Morgan, and they wrote what's called Modern Money Mechanics, which was adopted and became the Federal Reserve Act, which is the basis for our banking system today. It explains everything in the book, and we're going to touch on it a little bit in a minute. It was sponsored by Nelson Aldrich, who was married into, he was the senator, he was married into the Rockefeller family. Notice all these conspiracies, the same names keep popping up: Rockefellers, Rothschilds, Morgans, all this. What made me want to do this video, yesterday I talked about the mass media and how there's only a few conglomerates that control all of the media because they own them all. So it just made me think, to understand any of these things, you have to understand the whole big picture of conspiracies and the men behind the curtain, so to speak. So I decided to talk about this today, which is very important. To understand about the central bank, Thomas Jefferson once wrote some 200 years ago, quote, "I believe that banking institutions are more dangerous to our liberties than standing armies. If the American people ever allow private banks to control and the issue of their currency, first by inflation, then by deflation, the banks and corporations that will grow up around these banks will deprive the people of all property until their children wake up homeless on the continent their fathers conquered. The issuing power of currency shall be taken from the banks and restored to the people to whom it properly belongs." So these people were no idiots. They knew what was going on. So anyway, to understand what money, to understand what inflation or anything is, let's start from the very basics. What is money? You know, we think of money as the green stuff, right? Well, let's go back and see exactly what money is. There used to not be paper money, but once upon a time, hundreds of years ago, thousands of years, you had people would trade certain things. You know, you might trade a chicken for, you know, a quart of milk, or I might help you. You know, you can also exchange work. I can go help you at your house. You help me do something. Okay, I guess I'm back again. So anyways, money is just a system of exchanging work, services. It all comes back down to work. Even though you have a product to give to someone, you still have to work to get it. So it's exchange of labor is what it comes down to. So anyways, we're going to do a little experiment here, a little project, and it's very childish. It's so easy that your first grader can understand this, and that's the reason I'm doing this, so everyone can understand. If they would teach us this in school, the whole system would be flipped upside down. It's called the goldsmith's tale. Okay, let me move the camera to explain. Okay, hundreds of years ago, the goldsmiths, obviously, just like to keep your valuables in your home, you had a safe, right? Or they had vaults to protect their gold. Gold has always been popular because it's shiny, it's malleable, it doesn't rust, it can be used for all sorts of things. So people realized that, hey, you know, once they started getting gold in their possession, they would ask the goldsmith, hey, can you lock up, would you mind storing my gold or whatever value? He says, sure, but it'd be for a price. So someone would deposit gold with the goldsmith, and what do you do when you got to have a receipt, right? It's like when you go to Walmart or whatever. So this amount of gold equals one of these. Someone else, hey, let me deposit some gold too. Okay, here, you get this. So on and so forth. Okay, so one of these, one piece of gold was equal, you had a receipt. Okay. Well, after a while, instead of coming to exchange and taking my gold out, people realized it was easier to just start exchanging this. You'd go buy something from someone, you'd pay with this. This is what became money, which is just a receipt, because it was the value. In turn, it was backed by value. It was backed by gold. Now, the goldsmith started making a very astute observation. This person might withdraw his gold, okay, but someone else comes and deposited it. Someone else might withdraw. Someone would come and deposit. So they always had a certain amount of gold or valuables, belongings, whatever you wish to call it. And this was a very good observation he made. He noticed that no matter what, he always had a certain amount within his vault. And of course, by the way, he wouldn't store this for free. He would charge what we're calling now interest. So he was making money that way. So he started saying, well, you know what? Since this is already being exchanged as money, the receipts, I can start, they never bleed me dry. That today we'd call that a run on the bank. And I'm back. Okay. So what happened here, this is called fractional reserve. You have this much, but you're actually loaning out more. How can this happen? Well, it's because of the fact that no one ever comes and just claims their gold. Let's say it would happen. All right. This person bought this piece of, if this person came to cash out his gold, this receipt is equal to this piece of gold, but not anymore. Now, there are two that equal this. So, because he loaned out more than what was there, he just inflated or deflated the purchasing power, because now this can only buy half of this. Well, how can that be? I bought the whole thing. When I deposited this, further in a minute. That's where a fractional reserve comes from. All right. There's two parts to this video. First of all, this is the U.S. Treasury. This is the Federal Reserve. Currently, we have about a $600 billion deficit. That means we bring in, let's say, $2 trillion, but the budget is $2.6 trillion. So we need to borrow money. So the Federal Reserve, the Treasury Secretary, Jack Lew, calls up Janet Yellen, the Federal Reserve Chairman. Hey, I need to borrow $600 billion. Okay, we'll send it over. He prints out what's called bonds. Okay, he sends it over here. The Federal Reserve prints up some nice looking paper too. They print up the money and shift it over here. Now we just created $600 billion into existence. Where did they get the $600 billion from? That's just money we bought. No. This is where money is created. Big rolls of white paper with no ink, here at the Federal Reserve, or printed and created. This is where money is created. Okay, I'm going to go ahead and level with you. This actually doesn't even happen because it all exists in computers now. They're going to type in something in the computer that given $600 billion to show up in an account here. It's so lazy they don't even actually print. This is what you call fiat money, the actual dollar bill. It's tangible. You can touch it. It's the paper money. That's fiat money. There's only 5% fiat money in existence. That's right. So 95% of money, if you want to call it that, of our monetary value, exists in computers. If everybody cashed in everything, wanted money, there's only 5% of money that exists. Okay? Now, that's that part. That's one way of inflation, and I'm going to show you another. Remember, that was $600 billion added to the economy by debt. All money, because it's borrowed. And plus, by the way, they're going to charge 5%. They're going to borrow $600 billion. It's not even borrowing, because they're not borrowing from here because the money never existed. But we're going to borrow from something that never existed and pay 5 cents on the dollar. So we're going to pay, you know, what, 630 billion, an extra $30 billion to begin with. Oh boy, this internet connection is really getting to me. So, anyways, we're going to do another exercise here. Here's the, we're going to call this the Federal Reserve Bank. And where's the other one I had? Okay, I can't find what I'm looking for. So we'll go ahead and just call this the Federal Reserve. And this is going to be your local bank. Alright. The way it works here is, now there is a lot that goes into it, but for the sake of time, I'll just give it to you the simple version of it, because it goes a lot on how many securities the Federal Reserve buys and plays back and forth on how much money bank can have. Basically, in a nutshell, let's say you and I wanted to start up a bank. Okay, the Dozide Bank and Trust Company. I have $500, you have $500 worth of gold or money or whatever to give to the Federal Reserve. Okay, we're going to deposit. This is $1,000 that we deposit, or it's called high-powered money or reserve money, whatever. Now, you would think with a 10-to-1 ratio that, well, that means we'd be able to loan out $900 and have the $900 $100 of reserve cash. But that's where it's false. You deposit the $1,000 here. Federal Reserve says, okay, well, since it's 10-to-1, this is 10% of what you can actually loan out. So we're going to let you loan out $9,000. 1, 2, 3, 4, 5, 6, 7, 8, 9. Well, how can that be? Well, all this garbage they tell you about inflation growing because this and that. And by the way, remember, this equals goods and services. Money has to be created somewhere. Okay? Before the private bank, you know, government created money as a positive number, as a credit. They didn't borrow from an entity that doesn't exist. They would create money. Here's an interesting fact for you. Lincoln, there are 2 presidents that began creating money against the, you know, high powers that be behind the scenes, and they're both assassinated. That being Abraham Lincoln. He began printing greenbacks, which is money printed by the U.S. government, not by a central bank. He got shot in the head. Lincoln ordered $1.something billion of cash printed by the U.S. government. He got shot in the head. So there is a way to distribute money to equal the goods and services as the economy grows. If we still have the same amount of money circulating, I mean, then that wouldn't work as well. Money does have to be regulated with the economy, but not as a debt. It should be as a credit. So anyways, here's the $9,000. We started with $1,000. They're giving us $9,000 to loan out. Okay. Let's take this guy. Okay, you see this. No, put it right here. All right, this guy wants to buy a boat from this guy. Coincidentally, it costs $9,000. He comes take a loan out. There's the $9,000. Okay. He comes purchase it from him. He gets the boat. In theory, if this guy doesn't shove his $9,000 in a mattress, the money can keep expanding. At some point, he's going to take that money and deposit it into his local bank. And now this is when the ratio is flipped. It's not the 10 times. It's 10% which stays. So 10% is going to stay. Now, of course, 10% is going to be $900. This is representing 1,000. But just for the sake of the argument, instead of breaking down a bunch of little changes, pretend this is $900 that stays. And this is $8,100 that's able to loan out. Okay? Now, let's forget these people for now. we'll put this right here. This guy owes $9,000 to the bank. All right. So, and he doesn't even have the money. He gave the money to the guy with the boat. He has a boat now. All right. So now let's say this guy comes along and he wants to buy a car from this guy. He borrows the $8,100. He's going to come along, give the money to him. He gets the car, and he goes deposit his back to the bank. Same thing. It's $9,100. 10% goes there. Now you have all this. Now you have $8,100 being owed to the bank, and you have this chunk of the pie still able to be loaned out again. 10% of the $8,100 is whatever, 7,020 or whatever. So this, in theory, this process would keep going on and on and on till it reaches $100,000. So this is what we started with, remember? $1,000 can inflate to $100,000 theoretically if this process keeps going and nobody takes this and shoves it into a mattress. The deposits, the deposit reserves keep getting larger. The amount of money loaning is smaller, but look at all the money created here. At some point, this is going to all be paid back to the bank, thus inflating their deposits. You'll have a stack way up here, Now, the other little thing to it is interest. We didn't even talk about interest. We're just talking about the inflation. So if every dollar is in existence is owed to someone, because he borrowed from here, every dollar is owed to someone. If everyone would quit borrowing the way it's set up under the Federal Reserve Act, the economy will come to a halt because all money is created in a debt. So can we actually ever get ahead? Because you always are going to need more money because remember the interest. So he's going to have to come up with $9,000 of new money somewhere from the economy which exists, which is owed to someone else, to pay them. In turn, that's going to be loaned out and inflated. So is this guy. He's going to have to, and the process never ends. All right. Now you know that's where money is created. Despite what you may hear, because they won't tell you. You can hear on TV, they'll say, well, the feds are doing this and do that. And by the way, when the feds lower or raise interest rates, they're not actually setting a rate. I'm sure that there is some kind of ratio where they know about. What they're doing, they're just buying securities or bonds and in exchange putting more money for the reserve of the bank. Basically giving more money to loan out, and if there's more money, there's less interest rates. If there's less money, you got higher interest rates. So they single-handedly control the inflation and deflation, which is exactly what happened in the housing crisis of '08 and also in the Great Depression in 1929. Basically the same thing. That's what happened. Now, as money inflates, you've seen the exponential factor of it. $1,000 goes to 100,000 and everything else. We still don't have a current budget. The federal government doesn't have anything. We're still $600 billion in debt. Okay. So what does that mean? No, I apologize. We're $20 trillion in debt. We're $600 billion per year that we have to borrow from the Federal Reserve, and in turn, if you're looking at it on paper, it can never repay here because it's always going to be more because of interest. That's the way it is. That's why they don't teach you in school. That's why they won't teach you that in school. They don't want you to know civics and free enterprise. Doesn't even come close to any of this stuff. So let me explain this real quick before we go. I thought this is pretty interesting, just doing a little simple math. We're $20 trillion in debt. Okay? Let's go back to our little money I created, just like the Federal Reserve. This is a $1,000 bill. I've never seen one in person. Most of you watching this haven't seen a $1,000 bill. So just remember, we are talking about $1,000 bills, not hundreds or ones or anything. If you take money, $1,000 bills, and stack them on top of each other, not end to end or like this, you stack them on top of each other like a book. Okay, you got about 6 inches worth of $1,000 bills. Congratulations, you have $1 million. You can have about $1 million. Now, how many of those 6-inch stacks does it take to make a trillion? Okay. All right, take $20 trillion. You can take your calculators out now and try this out. You take $20 trillion. If your calculator goes that high, this is astronomical. Divide it by 1,000. All right. That'll give you 20 billion $1,000 bills. So 20 billion $1,000 bills equals 20 trillion. Okay, not $20 billion. 20 billion $1,000 bills equals 20 trillion. Divide that, by 1,000 again for our 6-inch stacks. We're gonna stick with that. You get 20 million 6-inch stacks of money. 20 million 6-inch stacks of money. Divide that by 2. We're going to convert it into feet. All right. So now we have 10 million feet worth of money. Again, stacked like this, like a book. So 10 million feet of money stacked. Well, we know that a mile is 5,280 feet. So you divide it by 5,280 feet. You get 1,894 miles of $1,000 bills stacked on top of each other, not end to end, on top of each other, which is basically the distance between New Orleans to Los Angeles, California. Okay, now let's just say, you might say, oh, that's not true. Okay, let's just say my math is off. Let's say it's not 6 inches. Let's say it's half, okay, which it's not. I mean, you can look at a book. It's not 3 inches. It's around 6 inches. That's common knowledge. So anyway, I'm upset with a mile. I mean, if we're in debt 1 mile of $1,000 bills stacked, we have a problem. Well, we're about almost 1,900 miles in debt. If you would stack it end to end, I'm not sure my calculator would go that high. You'd have to do, 6 inches times, because they're about 6 inches long, time 1,000. Well, it'd be, I mean, you could go to the moon and back, multiple times with the money stacked end to end. So anyway, with that being said, there's just something to look at and understand. Inflation and the Federal Reserve, they go hand in hand. They create it. That's why it's very important when you hear about ending the Fed. Well, what is the Fed? Is the central bank. By the way, there's nothing federal about the Federal Reserve. It is a privately owned corporation. It was passed on December the 23rd, 1913. Most of your congressmen and senators were home for the Christmas holidays. So Woodrow Wilson, was the president. He left just enough people behind to pass this. It's like a recess appointment or something like that. Obama does it all the time to pass his political agendas. So it was sponsored by Nelson Aldrich, but it was written by J.P. Morgan, Paul Warburg, who was an agent of the Rothschilds, and who was the first Federal Reserve chairman. I mean, on and on and on. Prescott, not Prescott Bush, but I mean, he was involved too, but the Harriman who worked with Prescott. You have the Nelson Aldrich, who was married into the Rockefeller family. This is a privately owned corporation, and that's why it hasn't been audited since the 1970s. Most speculate that the gold's not even there at Fort Knox or anything else, or at any of the reserve banks. There are 6 of them, 6 big banks. I'm sorry, or I think 12. So just because they gave it a name, Federal Reserve, it's not federal, and there are no reserves. That's the conspiracy behind it. Also, when you look into who really owns it, it's actually divided into hundreds of multinational banks and corporations. So there's nothing, by no means, federal about it at all. So that's your lesson today with money and Federal Reserve, and hopefully it pisses you off the way it does me. Thanks everybody for watching.